Okay, guys, thanks for joining us for another episode of Upstream with RiverX. Today, I'm joined by Jason Coggins. Jason, good to have you here.
Thanks, Kieran. Great to be here.
Yeah, and before we jump in today, we have a very brief disclaimer. Anything that we say on this podcast today shouldn't be considered as personal or specific advice in nature. This is just for general information purposes only. But Jason, I guess this will be the first time that we're introducing you to our audience, which is our clients, and you've obviously met our advisors, which is the other part of our audience, and you're well known in the financial advice community. But I guess for the benefit of our clients and listeners, can you tell us a little bit about your background in terms of who you are, your education, and where you are today?
Okay, so I spent about 10 years at a large private wealth firm where I built the research team with my colleague. That was a private wealth firm, high net worth individuals. We built that business in 10 years, from 0 to 15 bill. We were known for really identifying niche assets and strategies. After 10 years, I decided to go to consult to a bunch of groups. So if I think about what I'm doing now, 2 families, 2 fund managers, and 2 advice groups. Mm-hmm. Before that, I worked in consultancy land and also ANZ.
Mm-hmm. And that business you worked at, I mean, everyone knows about I think it was the journey at Coda, then you featured pretty heavily on the podcast and all that sort of stuff. Can you talk to me a little bit about that journey? Because that seems to be where you had a good breadth of your experience, and it's quite a remarkable journey, 0 to 15 billion in over 10 years. Mm-hmm. How has that shaped your career today?
Yeah, so I think there was a lot of hard work that went into that, and I think there was a bit of hard work, luck, and being in the right place at the right time. The firm Coda is a great firm with great people, and it really focused on providing great advice to clients and finding great ideas. Now, like your business, the first year is extraordinarily hard. And in fact, it was the first 4 years that was extraordinarily hard. So it was almost like that and then like that. Mm-hmm. I love advice. I love working with clients. I love working with families. Typically what we see in this market in Sydney and Melbourne and Brisbane, it's a very young, high net worth market. The average age of a billionaire is 50 years of age. We don't have second or third or fourth generations by and large. We have a couple of large families in Melbourne that are up to their second or third generation. But in Australia, the private wealth market is actually very young. And so being able to work with these entrepreneurs and being able to work with these people, they are absolutely fascinating. And I guess as firms get larger, and your role changes, you do become slightly removed from the client. And so, when I decided to leave that firm, Coda, I wanted to work closer with clients. Mm-hmm. And so, working directly with families, it's great.
Mm-hmm. And that's what we do as well. Yep. And in terms of your target market and the types of families you work with, what are the things that they normally look for?
It depends. So given that they are typically younger, I think that they like to do what they've done in the past. They want to rebuild businesses. If you're working with the second gen, they generally want to replicate what their father or their mother has done. The Australian market is dominated by a few things, right? Number one, it could be technology. Number two, it could be property. And so they typically want to do that again. The hard part is working with these entrepreneurs and creating a portfolio away from that so that they'll always have that wealth there. They don't want to outsource 100% of their net worth. They want to build the next business.
Yeah. And how do you fit in that picture? So because the way that we work with families is very similar. Yep. Most Australians, you're right, they have an affinity with property, and they'll have an affinity with a specific area, depending on their background normally, whether it's commercial or resi or whatever it might be. And then they'll typically have a business that sits adjacent to that. In terms of what you're doing with families now, are you like the full white glove concierge style consultant, or are you just looking at specific strategies or an overall sort of strategy for the family?
There's a few things. So, there's obviously I'm working for a number of different organizations on a consultancy basis. So, and a couple of families. So I think some of the families, it's just working with them in assessing ideas that they come up with. Helping them with strategy. Within the Ellerston business, Ellerston has a very long legacy as being almost a family office, first with the Packer family and now being Ashok's business. We see a lot of large families come through that business who are having major liquidity events. And so you would be so surprised how many businesses there are out there in the industrial land or the tech land where people are sitting on a business worth $200 to $1 billion. Now, these people are not necessarily financially or financial market literate. They have built a business, let's call it widgets. They sell that business, they have a huge liquidity event. And so it's helping them in that journey of Ellerston helping them sell the business, but then also how can we actually help the client work out what they want to do next? If that's finding them an advisor, if that's finding them a way to build the next business, if that's helping them to invest those proceeds.
And in terms of, and this is a very sort of general question, when someone comes to you and that liquidity event happens, are there any, because one of the main things that's being spoken about a lot now is asset allocation, alts, traditional assets. Where does someone put their money, especially during a time like this where markets are very volatile? Are you seeing any trends from those families in terms of where they want to deploy their cash?
Yeah, so I guess some of the themes that we came up with at the start of the year for one of the families I work with in Sydney, and this is just a broad asset allocation perspective, and I think it definitely worked in the first 2 months. Last month was a little bit more difficult, but I definitely see this playing out for the remainder of the year. So the first thing that we said we had a roundtable in December was the rest of the world versus the US. US valuations were extraordinarily expensive. Now, I'm not saying that was not warranted. I'm not saying you should not have exposure to the US, but when you saw relative valuations, the US versus the rest of the world, they were extreme, and you were not being paid to take that risk. We were talking about 2 to 3 standard deviations, expensive versus the rest of the world. So that was the first theme. Let's look at Asia, let's look at Europe versus the US and underweight the US. The next thing was the US dollar. Almost the same thing, but not. The US dollar was also extraordinarily expensive. And both of those really manifested into what we call US exceptionalism. And then the third factor was large caps versus small caps. Large caps, particularly in this market in Australia, you just saw a huge amount of money from superannuation funds and systematic beta and ETFs and passive funds flowing straight into the top 20. And you saw these old industry stocks, banks, insurance companies, telcos trading at 30 times earnings. They were trading like growth stocks. So look, obviously up until last month, everything's changed. I think that definitely the rest of the world versus the US is definitely something that will continue through this year. I think the US dollar will depreciate from here. And I think, large caps, they've definitely come down in valuations, but they're still expensive. And so they're the general things we're thinking of. Obviously, private markets is very relevant for these families. These families can take a multi-generational view. And, alternatives, there's obviously a lot of a spotlight on the asset class around valuations and transparency. I think that's a normal part. When I speak to families, I speak to advice groups, I don't think there's a systemic crisis in these private markets. A lot of this media attention, I think, is hype and obviously just demanding transparency given the growth of that asset class. And
I think we're seeing a lot of that now in terms of the growth, particularly in private credit, which I think is the most scrutinised at the moment. And then we're obviously seeing it in every other part of the alts market too. The couple of things you touched on there in terms of the themes you saw, we didn't talk about valuations of stocks in the US at our firm, and that was because we're pretty heavy in alts. So we've been pretty heavy fixed income, private credit for a while. So if anyone goes back to like our past few podcasts, that's all we've been talking about. And then now we've sort of avoided some of that volatility. But one thing we did identify was that gap between large and small caps. And everyone's been talking about it. And I think there are a select number of really good funds in this country that can really capitalize on that. And there's a whole bunch of others. It's sort of like in the alts market, what we're seeing now, you've got a handful of really sort of premium fund managers here, and then a range of others that are trying to play catch up. Now that you're at Ellerston and they've got a range of strategies in that space, how are those families engaging with you there to capitalize on that gap? And is it still, is the gap still there? You mentioned they're still expensive. Like how big is the gap now between large and smalls?
So to give you some background, so at Coda, we were invested in Ellerston Microcap Fund for, I think we're now up to 10th year. So I knew the strategy very well, and we've had a great journey. I think the issue that you've had with small caps is that it's been an under-owned segment of the market for a good part of the last 3 to 4 years. It still performed well, but a very under-owned part of the market. Why? I go back to that index, systematic beta, and the industry super funds. As we see a consolidation of super funds from 100 plus to 20 odd, these funds are going to be so big that they simply can't allocate to small caps. And so you're going to see this massive amount of inefficiencies in that market continuing. What you've also seen, and what is underappreciated, is the SIV market. The SIV market's been on hold for the past 2 years. Now, a big part of their portfolio, 25%, was invested in microcaps. And so that equates to around $300 to $500 billion that were going into microcaps every year from the SIV market. Now, that's simply not there now. So it is an under-owned market. Now, what's a really interesting part of the Australian market is, we talk about this at Ellerston, Australia has the lowest cost of capital in the world. And what I mean by that is our companies listed on the market will trade at premiums because of that huge amount of money coming into the market. And you saw that with the listing of Guzman and Gomez. You see that with a lot of the small caps. They come on and they're trading at 40 to 50 times multiples. Now, if you came to me, 15 years ago and you had a business that you wanted to list, your investment banker, Goldman Sachs, would say, go list in the US market. You'll get a 25 times multiple. In Australia, you'll get a 12 times multiple. That's completely changed now. And so the amount of money in this market is creating this low cost of capital, and you're seeing some interesting parts. Now, that's still, the IPO market has still not come back. So we're still, the IPO market has been on ice for the good part of the last 5 years across the world. Yeah. So there is this going back to your point around private markets, the public markets are becoming smaller and smaller. And that's creating huge, changes in how we invest.
But no, we're seeing it too. And there's this disparity in pricing. And there's the second part to that is the liquidity aspect. So liquidity seems to have dried up a little bit in the smaller end of the market. How is Ellerston dealing with that in terms of, do you cap your funds, or are you launching new strategies to deal with that? How are you navigating the liquidity situation?
Yeah, very, very good question. So Ellerston's product suite, and Ellerston is evolving like every fund management group out there. Fund management is becoming harder. It's becoming harder to beat the market, and it's being harder if you don't perform to justify fees. Now, I think what Ellerston's DNA and our competitive advantage is that our funds are always smaller. And so if you think about the micro cap capability, the maximum capacity of that fund will be $250 million. That's closed. That's full. The small cap fund, the Emerging Leaders Fund, will be $550 million. And the mid-cap fund will be about $1.5 billion. Now, why that's important? I think what you do see is that when you increase the FUM because you want to asset gather, you actually get into the larger stocks, and that's where the inefficiencies are less. And so being able to rotate and exit and enter stocks without moving the market, you can't have too much FUM. Now, I've seen some peers, and everybody has a different approach, but some peers will, in their small cap fund, will have an average market cap of $4 to $5 to $6 billion. Now, that's really mid caps. If you look at our small cap fund, the average market cap will be about $1 billion. In the mid cap fund, it will be about 4 to 6 versus something like 20 bill for some peers. So I think stay small, stay nimble, be able to move around the market, and really be able to leverage a very large investment team. So 6 odd people in that team. It's one of the largest in the marketplace, very well experienced. And, you have to have a competitive edge. You have to have an informational advantage. And I think as you get larger and larger and larger, you just look like the benchmark.
Yeah. And I think one thing that's interesting with Ellerston is it's always been sort of like a gated fund, if that makes sense. So it'll be open and closed, and so you can't really get in and out. But now I've noticed that you are actively engaging with the advice community a lot more. And is that because you've got the new strategy coming out where you can take more liquidity?
Getting to my point, Ellerston recognizes changes in asset management like you recognize changes in wealth management. The days of the big legacy fund managers charging 1% for a tracking error 1 to 2% product that meets the benchmark or maybe exceeds the benchmark by a little bit are over. The number of fund managers in this market, I think, is the most oversupplied market in the world in terms of ideas. You probably have 20 fund managers call you a week. There's a huge number of funds here, and I've always found it remarkable that there can be a great fund here, and it will raise capital, very fast. They'll get to $1 to $2 billion. It is an oversupplied market, right? There's a lot of capital coming in from superannuation and private wealth. If I go to the US, I can see a manager that's got a 15-year track record that's done 20% per annum and barely is able to get over $400 to $500 million. So I think that you get funded here really well, but there's a lot of managers that simply don't add value. At Ellerston, what we've decided to do is focus on what we're good at. And that's a big part of me coming in. It's a big part of the new distribution team coming in. What is Ellerston's competitive edge? They know the life cycle of small, medium-size, and micro-cap companies, both from private and public. So, as an investor in Ellerston, and we were the second largest investor in the micro-cap fund, I did not appreciate the intellectual capital that is in that business on the private and the public side. And so if you think about what they do on the private side, it's almost shorter duration PE. The idea is to hold these private companies for 2 to 3 years and then list them or sell them. And so for the investment team, they're actually able to see the full life cycle of a company when it's private, when it goes listing to a micro or small cap, and then as it gets larger to the mid cap. So having that full life cycle appreciation of companies, it also enables you to look at private companies that may be a competitor or maybe a supplier or maybe some other relevant characteristic.
I think what we're seeing in the Australian market as well is more companies staying private opposed to going to the listed market. So having a fund that caters to that space is key, and that's why I think we're seeing more people going towards the alt space because there are some really, really awesome companies that are staying private. And I think that's got a lot to do with the regulatory landscape. A lot of people don't want the scrutiny or they don't want the headaches because we are a sort of highly regulated market here in Australia, and it's a lot easier for them in some cases to access capital by staying private as well, and they can get better valuations on the exit. For your sort of late stage PE buyout style funds that you have, what are the returns like? What does it look like, and what's the average duration in that fund?
Putting me on the spot, Kieran, but so look, we do have a chart in Ellerston. Again, I feel like it's good DD, bad DD. I didn't know this when I was an investor. As an investor in Ellerston, I wish I appreciated it more because I would have, spoken about it a lot more. But Ellerston has had about, I think, 30 exits in private market assets, and we're talking about a 50% plus gross IRR and an average hold period of less than 2 years.
Okay.
Now, that's over the last 10 years. I do think private markets, it's harder to exit at the moment. It is very hard to exit, and you're seeing that across private equity. You're seeing that with the number of continuation funds that are coming out. Now, it's always dangerous to look in the rearview mirror and go, it's going to stay like this forever. The IPO market will come back, exits will come back. As interest rates come down, the IPO market will be supported. As we exit this period of volatility around tariffs and Trump 2.0, I think the market will stabilize a little bit better. Now, our general macro thought, which is not necessarily Ellerston, but it's within the families, is that the volatility will remain until February next year. Trump will push and shove and try and change the system, and he's got free reign until they start campaigning for the midterms. Now, when the midterms come up late next year, the Republicans will not want to lose the Senate. So I think we've got, unfortunately, a period from now until February where the market will go up and down and there'll be no clear direction. Now, when we come into 2026 and the US is focused on the midterms, I think everything settles down.
And then is that because Trump doesn't have as much to lose, or he has more to lose at that time, so he's going to have to get back in his box a little bit? Because at the moment, I think they're calling it the tariff tantrum at the moment. And it seems to me like he's got nothing to lose.
He's got nothing to lose. I think in any Trump negotiating tactic, the first offer is extreme, and that it sets the stage for negotiation. Now, the best case scenario, and probably what he wants to achieve, is he wants a full trade deal with both China and the EU. If that happens, he'll then want some type of accord to depreciate the US dollar. Will it happen? Who knows? He's got nothing to lose. It's his second term. He's in his first half of his second term. He has the House, he has the Senate, and so he's got a year and a half to move and shake the system up and down, and we're seeing that. Now, I think when we come into the back end of next year, the Republicans will be solely focused on maintaining the Senate.
And let's just talk about what that does for your funds and the Australian market here. So we've got volatility, uncertainty, that's really impacting exits to from public to private at the moment. What does it look like for our everyday investor out there? Because now the talk is, with all this volatility and asset prices coming down, we're pricing in 3 or 4 rate cuts between the end of the year now. Are you seeing that sort of outlook now? And how does that impact the way that you and Ellerston will be investing going forward?
So you're 100% right. If you look at the RBA implied futures, it's now factoring 4 to 5 cuts.
Okay.
So it's extreme, right? So that is going to have a huge positive impact on asset prices. Now, I think, by and large cap equities are fully valued. I think you still get opportunities and inefficiencies in the smaller end of the market. I think what you'll see is property markets, direct property will be supported. You're starting to see that in Australia. So the down and out asset classes 5 years ago was large retail malls in regional locations. You could buy those on cap rates of 8-9%. You're starting to see capital come back into that market. We have not delivered a new large mall in this country in 20 years, and the population's gone up.
Well, we can buy them 50% below replacement still.
Commercial as well. Yep.
Yeah. So we get shown this product all the time. So from like Centuria and Centennial, all the other different product issuers, they come to us, and what we've seen in the last 5 years were 8s, 9s, 10% net yields that we're getting paid as unit holders as part of a syndicate. And we're seeing total IRRs 15 to 20% on a regional or a sub-regional shopping centre, which is something that you wouldn't have seen 15 years ago. And that's because the super funds had overinvested in the space. There's a divestment, so more stock on the market. And that's how we've been finding some good commercial real estate deals. But it feels like that's coming to an end. It's slowing.
No, I think commercial will see more. And you hit the nail on the head. It wasn't just super funds. It was these large funds that, had redemptions. And, it's a perverse outcome. And I don't want to criticize any one manager. But the remuneration structure of these large property groups, they follow fads. So, they had, their remuneration was based on exiting retail malls and going in industrial at 2 to 3% cap rates. Their new remuneration model is based on exiting offices and going into the new fad, data centers, right? And so if you can be contrarian and do the opposite of what they're doing. Now, office towers, the issue with office towers, and, we have participated, this is outside of Ellerston, this is in some other groups, we have participated in some of the office towers. You got to be very selective. You haven't seen so much stress in Sydney. So Sydney, the Japanese love to buy office towers here. So anywhere from Martin Place to Circular Quay to George Street and Macquarie Street, you're not going to get discounts in that market. You're also going to see supply come in there, and offshore investors love that market. Where some of the more interesting deals have been has been in Brisbane. So Brisbane population growth is phenomenal. You have the 2032 Olympic Games. You have replacement values being very expensive, and you've really only got two major new supply, Dexus at Waterfront Place 2 being one of them, being quite large. Outside of these projects, there's not much supply. Now, if you can buy these at, 50 to 60% of replacement value, they're fully leased. You can, lock in debt, 50, 60% LVR, you're looking at a pretty attractive overall, yield and IRR projection.
Did you look at the Eleanor ATO government asset in Brisbane?
No, I didn't.
We've been seeing from a few different issuers. Growth Point was one. Eleanor's another, and there's been others. We're finding office towers as federal government tenants,
long-term leases,
10-year plus lease, 10% plus yield. And you're right, that Brisbane market's really interesting because now it's that office market is completely different to Sydney and Melbourne.
It is.
And the vacancy rates are totally different as well. So that market is really interesting.
There's an interesting point in Brisbane and Adelaide and Perth, and they call it observational roles, right? So there's a lot of government workers, there's a lot of people who have to be in the office. The problem that you have in some offices in Sydney and Melbourne is it's white collar professionals who can work from home. So you're actually seeing the occupancy of people coming into the office for 5 days much higher in Brisbane and Adelaide than it is for Sydney and Melbourne. Now, no one property market is the same. You look at something like Melbourne, these large format campus style developments are a disaster, and these will be these have no value whatsoever. So areas like Docklands, these large format campus style developments, they are not where you want to invest. You want to have a B grade asset that can be repositioned in a good location in the core part of the CBD. I think that's a contrarian play at the moment. Like it's not, you don't want to go in all in, but I think you want to follow where people are selling for non-economic and non-financial reasons. And someone exiting an office tower at a 9 or 8% cap rate that's fully leased in a good location is probably a non-economical and non-financial decision because they've got redemptions in their fund or they need to exit for another reason.
That's where we're seeing opportunities for sure.
Yep.
So tying that back into the global view, like obviously what we're saying is that it's going to be buoyant for property prices. And
here, domestically, I think so, yeah.
Yeah, and I think that's important for our clients who might be listening who have homes. But I think Resi property has got some great metrics around it, in particularly with the immigration and vacancy rates and whatever in Sydney, which is where a lot of our clients reside in Sydney, eastern suburbs, and around the country. But you're saying sort of 4 to 5 is the forecast for the cash rate to be slashed. So,
cuts,
in terms of positioning portfolios now, if you're locked up in a TD with a 3, 6, 9 month redemption, is that something that you should be planning and saying, okay, which risk assets are on my shopping list for the next quarter or the next sort of 6 month period?
So look, it's hard because a high net worth portfolio is generally not over allocated to equities. Right? They'll have fixed income, they'll have private credit, they'll have some other defensive alternatives, and they'll have some equities. I think, I'm not so certain buying the dip right now, particularly large cap and US. I think you always want to be long equity markets over the long term. I think that you want to be opportunistic and take advantage of some of those property assets or some things that come you don't expect. But look, I think positioning, I would not be taking excessive amounts of risk, but I'll definitely be remaining invested for your strategic allocation and then just moving the needle a little bit.
Buying the dip, something like where my office is, where it is, there's a pub nearby, and all the transactional brokers hang out there. So every time I'm going to the gym or going for a walk or something, I see all the old school transactional brokers who are sort of in the pub by 11 and back at the desk for the close at 4, and they've all been buying the dip. The conversation has been where buying the dip, and the dip, as it turned out last night, is continuing to dip. What's your view on where you think this goes? Like you're saying valuations are still high and you can't pick a bottom, that granted, but just roughly speaking, how much further do you think we have?
I think markets can go down 10, 15% from here. But I do think it's going to be range bound. I think it's range bound. I think, if you look at the global economy, there's no systemic risk apart from trade wars and maybe some geopolitical tensions. The banks are relatively healthy. Leverage is okay. Liquidity is okay. And so the systemic risk is more noise than anything else. And I do think that, this year will all be about, Trump posturing and making noise. And then next year it will be a much better place. We have interest rates coming down. We have, Europe. We haven't spoken about Europe. I mean, Europe in a crisis comes together. If you look at the German fiscal plan, they are going to stimulate like something we've never seen before. They will run massive deficits for the next 5 to 10 years. They'll spend a lot of money on defense, and they'll still be one of the most lightly geared countries from a fiscal perspective in the globe. So I think the next 2 years will be about divergence. And the US is an expensive market. You weren't being paid to take the risk. It's still a very high quality market, but where it was trading versus the rest of the world, you weren't being paid to take that risk. China's an interesting market. Obviously, there's geopolitical risk. I've been fortunate that I have been to the mainland about just under 10 times. So I've learned a lot about China. I really feel that I have an appreciation of China. If you look at the top 1% of people in China, the scientists, the entrepreneurs, they are as good, if not better, than the US. Now, China tech was trading at like 10 times. US tech was trading at 30 to 40 times. Yes, US, less geopolitical risk, maybe not now. But you just, the relative valuation, that's how I've always invested in my life. Look at relative valuations, be paid to take a risk, and, just invest for the long term. But if you've got 3 options and one is trading at 2-3 standard deviations versus the rest, it's probably not the time to pile in.
And are you incorporating sort of multi-currency lending into your strategy as well to sort of leverage into those different markets? Is that something that you'd recommend or facilitate for the families you work with?
Yeah, most are based here. So the 2 families are based here. Look, currency is a hard one. I treat it like an asset class itself. So, obviously, most of our liabilities are in Australia. We live here, we spend here. So look, I think the Aussie dollar component of any portfolio is going to be the largest. At 62 cents, I still think it's cheap. And I do think the US dollar depreciates from here. I think that will be phase 2 of Trump's agenda. After June, in the second half of the year, this will be where he wants the currency to depreciate. Let's be honest. You're not going to make iPhones and you're not going to make textiles in the US. It's not going to happen. Like, that's not what he wants. But I do think he wants a fairer playing field for US trade. And at the moment, you could argue that it's not fair, right? The US, has had free trade for, the good part of the last 30 years, 3 decades. US still faces tariffs everywhere going into other countries. So I think the tariff is phase 1, and then phase 2 is, some type of potential accord where there is a global acceptance the US dollar will depreciate.
Yeah, and I think we've seen all the memes going around at the moment of the US factory workers and Elon Musk manufacturing iPhones. I agree. There's so much that goes into that supply chain. It's just not going to happen.
Yeah.
I saw an interesting stat the other day that US is about 15% of overall Chinese trade. Is
exactly 14.
So it's right there. It's not as meaningful as it used to be.
No.
So it puts the Chinese in a very interesting bargaining position where it'll impact them if the US isn't there, but they'll get by.
I think they will. The problem for China is it's an aging population. There's a lot of debt in that economy, but I think the long-term planning, they'll get through it. And like you said, they 14%, 15% of their exports go to the US. It's not as large as what some people make it out to be. The real issue is we spent the last 30 years creating a global supply chain based around China. If we are to unpick that and create regional supply chains, that will mean that inflation remains higher for longer. And that's probably one of the big risks in markets. It's a stagflation environment where inflation stays high. It is definitely moderating. If you look at Australia, we're smack bang in the RBA's target, and so we will see rate cuts. But globally, if tariffs do come about and that sees a reshoring or new supply chains based regionally, that will be negative for inflation and negative for growth. And that's what the market felt yesterday. One of those fears.
And we're seeing. So look, if that would happen, that's a 10-year journey to get those supply or more to get those supply chains up. It's not like China just built those supply chains yesterday.
No.
So to reshore all of that work, it just seems like it's a bridge too far in my mind. I think that there will be some sort of an accord, as you say, and then that could be a good time to deploy some capital when we see things start to settle down. In terms of deploying capital, we get the question all the time because what where we're winning a lot is look, we're seeing a lot of low quality advice in the Australian market still. We're seeing a lot of people who've been almost 100% in equities and they're sick of the volatility, or we're seeing other people coming into liquidity events, which is what you were seeing at Coda and with these families, and they're looking for opportunities to deploy cash. I know that you've got one fund which with Ellerston, which you're looking to bring to market in the short term. How would that work? So let's say you're raising capital and you open a round for that today. How would that work in terms of settlements, deployments, entry points? How would Ellerston look at deploying that capital to get best pricing?
Yeah, so again, the focus of the Ellerston suite of products is in the most inefficient parts of the market. So you're not buying, you're definitely buying beta, but you're not buying high beta. And so I think, again, I've always had, and in my own personal portfolio, I like small caps. I like mid caps. I think that's where you get the growth opportunities. And I also think it's where good quality managers can demonstrate their skill. I think differentiating between CBA and NAB or Telstra and QBE, you're not going to add much, outperformance. You shouldn't pay a fee for it. And the question should be, should I be there to begin with? Not what manager should I be in? In the small and mid cap space, I think if you can deal with the volatility, you're going to get good numbers. Now, if you look at, something like a Morningstar median manager, that small cap index, you could say that it's not high quality, but that median manager outperforms a small cap index. That's a good thing. So you're paying for alpha. But most importantly, most of the top half of managers outperform the ASX 300. So you're outperforming large cap equities. So, you can put a smaller weight into small caps and mid caps, but get greater outperformance for the portfolio. And on a beta adjusted basis, it's probably like having a larger allocation to large caps. So for me, I think, and at Coda, we had a large strategic allocation to small caps through the cycle, call it 6 to 8%. It enabled us to have less equity market risk elsewhere. If I look at the attribution on both relative against the median manager and the biggest contribution on an absolute basis, it was the small caps.
Mm-hmm.
But you got to deal with volatility, so it does go up and down. And I think the story is very similar for mid caps as well.
Yeah, but before I met you guys, I was investing a lot in the Regal Small Caps Fund, and we still have exposure there. But I remember during COVID, the volatility was extreme, and we saw might have been a 60% drawdown on that portfolio at the absolute worst. And if you look back at their chart, that's a big big drawdown that we saw on that portfolio. But then coming out the other side of it, it absolutely ripped, and we might have been up 120% from peak to trough.
Yeah, and I think the thing about small caps is a lot of managers will have style biases and mid caps, so you want to blend those to some degree. You don't want to over diversify, but something like Regal, it's quite punchy. You can have more GARP style approaches. You can have a more value oriented approach. So it's about blending the managers. But I think collectively, I feel it's an easy source of alpha, and it's one that you want to be invested long term on a strategic basis.
And with Ellerston, so you've got your small cap strategy, the mid cap. So there's basically three strategies that you have running at the moment. Is the only one that's coming up to be open the mid cap strategy? The rest are basically soft close at the moment, if I'm not wrong.
Look, emerging and mid caps are definitely open, and the micro is just much more capacity constrained. But Ellerston's a unique business. We are investing for growth. We have a new defensive capability with Wimmel Gore, who joined our business, ex-Pendle. We have a great private markets capability, both the industrial growth and Jade side. So part of my role there is to focus on new ideas and who we bring them to.
And I think, look, it's always a privilege to be connected with fund managers like yourselves that have got that rich history in the family office market, because ultimately that's where we see ourselves as a firm that's trying to democratize access to investments that are predominantly or have historically been restricted to that market. So it's great to be connected with the team. If someone wants to learn more about Ellerston or learn more about you, where can they find you?
Yeah, so we're going to do a lot more events. We'll do a lot more marketing around our capability. We'll do a lot more boardroom sessions. We will, I think, come and present to your clients. But look, the great thing about Ellerston and the other firms that I work for, Initium, Ibex, as well, is that these are all privately owned companies. And I think this is an interesting, aspect. And, again, I didn't appreciate this outside of Ellerston, but I appreciate it a lot more now. Funds management is a really hard game because you go through big cycles. Being privately owned enables us to look through the cycle and invest when we need to. Being publicly listed just creates other challenges. So I think Ellerston is in a really good spot at this point in the cycle to navigate this volatility, work with our clients, and invest in new capabilities, which we've done. The mid-cap fund is a perfect example of being able to innovate. Wimmel Gore, bringing him on board, is another thing that we've done over the last 12 months.
So basically, you have to deal with your advisor to get access to Ellerston. Don't call direct unless you got a big check. Because I think they had some minimum. What's the minimum?
On platform, it's nothing. I mean, platforms, it's easy.
That's because you've got someone who's basically an aggregator there.
Absolutely.
So that I think that's important to deal with an advisor when you're looking to get access to Ellerston. And we will be hosting some events with you. We have I think we've got a wine tasting night.
Okay, good.
Coming up with some of our clients with you. So. We'll send out the invite and see who comes along.
Good.
Is there anything else you'd like to add?
No, it's good. So look, I think the next 8 to 9 months is going to be interesting. I don't think you need to be reactive to the news that comes out every night. I don't think you would want to take any meaningful changes to portfolios. I think over a 2 to 3 year, markets will do what they do. But I think the remainder of the year will be volatile. But I think selectively allocating to the market, keeping an eye for bargains, having sufficient liquidity. I think portfolios are all about having enough invested in growth assets, which may be liquid, may not be, but also having liquidity to be able to opportunistically invest in new ideas. And it's that balance. You don't want to be overly liquid and not take risk, and you don't want to be completely illiquid.
Yeah, I think you're absolutely right. That's why we've kept this balance between fixed income and private credit, so we can pull those funds and go back into risk assets if we need to be. So it feels nice not being too exposed.
And I think it's an interesting point. So for all the noise around illiquid assets and private markets, let's say private credit, in this environment, that is probably going to be what underpins low volatility in portfolios.
Yeah.
And the question is, we want growth assets, we want equities, but keep it to the strategic limit. But the noise around private credit, it's going to stick around. I want to reiterate, I don't think it's a systemic risk. There's going to be good players and there's going to be bad players. The good players will be able to work through loans and fix loans, but the Australian market is inherently stable. It's all bridge financing, right? And it's typically asset-backed and senior secured. So yes, there's a lot of noise. Yes, there should be more transparency. Yes, there will be some, events where capital is lost, but by and large, this asset class benefits from two tailwinds. One, people want income. As people deaccumulate and exit super into retirement, they will want income. And second, companies and the economy needs lending. So you've got these massive tailwinds. The asset class is not going away.
Yeah, I think to address the issue of the visibility and the optics on the underlying investments, a lot of these funds are now coming to market. So there's really nowhere to hide in the listed space in terms of continuous disclosure, right? So I think that if there was a fund out there that was dealing with an issue around disclosure, coming to market is number one, the hottest way to raise capital right now. Everyone's doing it. If you're not Warcrossed, I know that I am on like 6 or 7 others between now and the end of the year.
Correct.
So regardless of M&A activity slowing down, we're seeing new issuance in debt markets to plug the hole from the hybrids that's going to be left. And you're right, you've got those two big tailwinds there. People need a place to park capital. The second part is most of them have a function where you can reinvest the dividends or distributions, not dividends, every month, which turns it into almost like a growth fund in these conditions where you're not seeing drawdowns and you're getting that compounding effect. It could be 8 to 10 or 12%. So maybe before we wrap up, because I know we sort of said 30, 40 minutes, if you had some criteria for someone who was looking at a private credit fund, would it be like first mortgage, under 65% LVR, any sectors? Are there any sort of maybe 5 or 6 pieces of criteria that you tell them to look out for?
I think there's probably one major criteria, right? Or two. You're being paid to take the risk. Again, you're getting an acceptable rate of return for the risk you're taking. Second is you need to be comfortable that the manager can work through loans. A great manager that I know talks about private credit. You get your 9 to 10%. Best case, your worst case is you get fixed income returns. I like that asymmetry. That's a nice place to be. But to get that kind of outcome, you need people in the business who can work through loans and fix problems. Because the real problem in private credit is a loan goes stale and you don't fix it and you don't have the capability internally within that fund or that business to fix the loan because it costs money and time, legal, and all different stuff to get your money back. So, lending is very easy. Anybody can lend, but it's about being repaid and getting the loan back, and that differentiates the best manager from the worst manager.
Well, Jason, thanks so much for your insights. Thank you for your market wrap today and telling us all about Ellerston. And thank you, everyone, for joining us for another episode of Upstream with RiverX. Thank you.
Thanks, Kieran.
Cheers.
Thank you.
Thanks.